Welcome to the 2022 second half outlook Oak Harvest Financial Group. I am Troy Sharpe, CEO, along with Chris Paris, our Chief Investment Officer. And we do this every single year. We do this twice a year. And tonight we're going to talk about the signals and the trends and what we're seeing in the market and also behind the scenes that help us build these forecasts that we've been sending out to clients. Chris, you've been putting them on the podcast every single week. And a lot of what we're going to talk about tonight, we have covered over the past several podcasts. But I know many of you, even though no matter what you're doing, you always try to tune into the podcasts, I'm sure. Maybe you haven't got all this information. So we're going to summarize it, we're going to condense it, and we're going to talk about what we expect the market to do over the next, into the end of the year. But also, really, this is the next 6 months we're talking about here, Chris. So Chris has done an astounding job communicating to clients and also everyone who listens about what he believes the market is going to do, along with the signals and the trends. Of course, we don't put the entire secret sauce out there and the calculations that we use behind the scenes, but we do try to help people as best we can understand what it is that we're seeing in order to help you tune out the noise and really understand why we're making the moves that we're making and what type of moves we anticipate making over the next couple of weeks, couple of months, etc. So to provide some context here as to the accuracy of these forecasts, and of course forecasts are just that. You don't have any guarantees, but Chris, I've been impressed since the very first day I met you. This is almost 4.5, 5 years you've been here. I remember you came to me in 2018 and you said, I want to start doing these podcasts. I want to start doing these forecasts to help people understand what it is that I see behind the scenes to help them, if not for anything else, just feel more comfortable when you hear Jim Cramer on TV or you hear what's going on Fox News or CNBC or whatever channels you're watching. The purpose of why we do these and why Chris does the podcast every week is to really help you tune out that noise. So just to provide some context of why this is important and the type of accuracy that we've been able to convey over the years, I want to go back to 2018. And our first forecast that we put out in the end of 2018 for the first half of 2019. So if you remember, the market had just corrected 20%, and I love the way we define these. So at 20%, it's a correction. The market was down 20% in the fourth quarter. And unsurprisingly, all over television and print, there were calls for you to sell your stocks and go to cash to protect against the next market crash. On December 31st, 2018, the S&P 500 stood at 2531. Meanwhile, the title of our 2019 first half outlook was Put on Your Rally Caps. We were quite bullish. Chris explained that he expected most of the gains in 2019 to come in the beginning of the year with a slowdown into summer and an acceleration of gains into the year end. We had a 3,000 price target on the S&P 500 at that time, the end of 2018 for year end 2019. Not surprisingly to anyone here, the first half of 2019 played out as Chris had forecasted, with the market up about 18% in the first 6 months, followed of course by the slow summer of virtually no gains. At that time, we released our second half outlook, which was slightly revised. We increased our estimates up to 3,100 on the S&P 500. The results? Well, the market finished at 3234, slightly above our bullish forecast that we put out 12 months prior. For our 2020 outlook, Chris forecast a strong beginning of the year with a max upside at the S&P 500 of 3,350 to 3,400. On February 19th, the market hit 3,393, leaving us just 7 points off, or 0.20% off our upside target. Of course, COVID then took everyone by surprise, and the market proceeded to sell off 30% plus. On March 24th, right here on the YouTube channel, and this video is still out there if you go to March 24th, 2020, we released a video explaining that we see signals of a strong stock market recovery beginning to take shape, while we made thousands of calls to clients explaining why we should stay the course, why you shouldn't panic and get out of the market. And with tons of uncertainty abound halfway through the 2020 recession in the middle of COVID, we put out our second half outlook, and it wasn't just COVID, it was the upcoming presidential election between Donald Trump and Joe Biden. We put out the forecast that a year end, our expectation on the S&P 500 was 3,450 to 3,500, a massive upside from where we were currently sitting at that time. Chris, you also said in that forecast that it was quite possible that we would hit 4,000 on the S&P 500 at the end of the first quarter in 2021, 9 months into the future. We laid this case out in many details on podcasts that you can still go back right now to this day that we have on the website, we have on the YouTube channel. And we explained that this was a likely outcome irrespective of who won the election. Well, we were proven right, as the S&P made its way past our target all the way to 3756 at year end. Our forecast for the first quarter of 2021 of 4,000 as the market ended Q1 at 4,019, a mere 0.48% off from our forecast 9 months prior, which was in the middle of a COVID recession with the uncertainty of the upcoming election at our feet. The 2021 outlook, the market ended 2020, as I said, around 3756, and we reiterated our belief that 4,000 to 4,100 was possible by the end of the first quarter, which we missed again by less than 0.5%. Our mid-year forecast called for the S&P 500 to very likely hit 4,600 by the end of the year, and a move to 4,800 on the S&P 500 was quite possible. Well, the S&P ended that year at 4766, again, a mere 0.7% off our upside target. So Chris, we then most recently put out the first half outlook for 2022, and on December 3rd, you wrote that the first half of 2022, we're expecting much higher realized volatility in the first 6 months of this year, with a likely correction of over 10% for the first time in 18 months. Despite that forecasted correction for the first half of 2022, we still felt that this would be a positive year for stocks. So Chris, that's an amazing rundown and summary of the past 4 years, and I know you're blushing, and I know you're probably a little bit uncomfortable right now, but it's important that we understand what you've been able to do on this side. And as I said, there are no guarantees when it comes to forecasting. All we can do is make our very best guesses based on sound economic data, experience that you've had over many, many years of managing money in the public markets. And this isn't the first time you've done something like this. Chris, you managed the AIM Large Cap Opportunities Fund to a #1 national ranking for performance, the Quaker Strategic Growth Fund to a #2 national ranking over both 3 and 5 years for performance. Then, of course, managed the Invesco Constellation Fund, helped implement a performance turnaround over a 3-year period, growing assets from $14 billion to $33 billion. So with that introduction,
Troy, you're hired.
and tonight we're here to talk about 2022, but you have so many people that you listen to. You're inundated with commentary, with what you read, with what you hear. It's very important that you understand the history of people that provide you guidance when it comes to what we expect to happen either economically or within the stock markets or bond markets. Chris, with that said, I built you up, but now I also do have to talk a little bit about where we went wrong this year. We talked about the 2022 forecast. You called it way in advance. The volatility, first half of 2022, about 10 to 12% is what we expected the pullback to be. What happened? The market pulled back in the first half of 2022, a little bit more than we had anticipated. Tell me kind of what happened and what transpired.
Yeah, well, point to point, if you were perfect, which no one is, I think from the very top, I think it was January 3rd to the very low on June 16th or something, we had a bear market. I think it was 24% if you were absolutely perfect selling and perfect buying, which no one is. So you take out the tops and bottoms, and maybe, it was probably like 18% or something like that. Underestimated lack of liquidity on the way down, and the concerns about inflation and what the Fed was going to do. And anytime you start to get rolling downhill and there's been a really large move to the upside like there had been for the 18 months prior, I think it's Warren Buffett said, you find out, when the tide goes out, you find out who's naked, I think is what he said, or who's swimming naked. That's kind of what happens. And we look at a lot of indicators and measures that they don't talk about on TV. They're more institutional, but we get to see a lot of these big players are leveraged, and they are forced to sell at the bottoms. They don't want to sell on June 16th, but they don't have any they don't have any say in the matter. Yeah. Right? Their prime broker calls them up and says, this is a margin call. It doesn't matter what price, we want our money back. And that's what happened at the middle of June.
Yeah, you see, so for those of you who may not fully understand what Chris just said, a lot of these large institutions and huge hedge funds, they borrow money. They create leverage to essentially buy more stock. And when things are going well, they can create tremendous returns. But whenever you borrow money and then the markets go against you, well, then you can get a call from whoever lent you that money saying, hey, bud, we need that money back. Your bet is going in the wrong direction. So then they're forced to sell a massive amount of securities, which can then exacerbate the already existing downtrend and, of course, cause the markets to fall even further.
Yeah, a lot of the data that we look at, it's behind the scenes, it's institutional, it's very quantitative, but no one can forecast a black swan. You know, you hear about them on TV all the time. Black swan this, black swan that. The definition of a black swan is it's random. You know, it's unforecastable. So 9/11 hits, that's a black swan. You know, COVID hits, that's a black swan. There's other ones like that. So events like that, they come fast, they come quick, they're severe, usually recover very quickly. The other events that are slower, more economic, you can see them a little better because you have a little more lead time.
And I remember talking to you in kind of the middle there of, you know, let's call it, you know, April, May into June, you know, what's going on? Why are the markets reacting so extreme? And we had this conversation about the leverage out there in the market. And of course, the Fed was a bit more aggressive than we had originally anticipated. And inflation persisted a bit longer than we had originally anticipated as well. And that's part of the deal when you're managing money in the public markets and you're talking about forecasts and you're trying to manage risk. There's only a certain amount of things you can diversify away from. And there's only a certain amount of risk that you want to hold, and then others you want to kind of transfer to other places as far as risk transfer techniques and risk transfer strategies. Our job is to we're going to talk a lot about financial planning. At the end of tonight, we're going to bring up Jessica Cannella, who's the co-founder and president of Oak Harvest Financial Group, and Ryan Kenny is going to make his first time ever appearance on YouTube as well tonight, and they're going to talk a little bit about financial planning. But our job, investments is really one part of the overall plan when it comes to retirement. Right? When you're in the accumulation phase, investing is pretty simple. Buy the market, stay invested, put as much as you can into it, and really turn off the TV, don't look at your statements, and 30, 40 years later, hopefully, probably, you've accumulated a massive amount of wealth. In retirement, it's a lot different, okay? We're goal-based planning, we're risk-based planning, we're looking at how much income do you need, when do you need that income, what about taxes, can we reduce your taxes, healthcare, estate planning. So we're building investment portfolios to achieve specific goals on a customized basis for clients. We don't put you into a box. What we do is we build that box around you, and that box is specialized to your particular circumstances. So we didn't see what was going on in the first half of this year. Even though we called a 10 to 12% correction back in December for the first half of this year, we didn't panic and say, you know what, we need to go to cash because the market's down 15 or 20%, because we have investment strategies that are tailored to your long-term goals. So for us, we didn't see anything structural wrong with the market and nothing that we should make massive moves to disrupt the pre-existing investment plan. It makes the most sense in those situations to go ahead and stay disciplined. Very important word when it comes to investing in retirement, having a plan and staying disciplined. And this goes for the tax side of things, the income, every aspect of your plan in retirement. We have to stay disciplined. Otherwise, let's not even put the plan together. So it's been an exciting first 6 months of the year, but tonight we're really going to explore what we see happening over the next 6 months, how much of our original forecast that you put out on December 3rd for the second half of 2022 still holds true. And then we're also going to answer some of your pre-submitted questions. And as I previously said, we're going to bring up Jessica and Ryan to talk a little bit about how the investment planning ties into financial and retirement planning on the back half of tonight's program. So we should be done in about an hour's time from when we start. We may go a little bit longer, but we do appreciate you tuning in tonight. If you're not subscribed to the channel, if you could just take a moment to subscribe. This is how we keep you connected to your money and keep you updated with what we're doing here on the investment side, but also the financial planning side. And Chris, I have to admit, the only videos I've ever seen on YouTube that are better than yours are mine.
No comment.
With that said, we're going to transition into some of the slides that we have prepared for you tonight. We're going to get right into the signals of what we're seeing on the investment side. So, Eric, if you could kind of put up that first one talking about real interest rates.
And I just wanted to pop on, our marketing director informed me that anyone who was waiting for the program to start, we had a slight technical issue where there were 2 links set out, and so if you were waiting, we just want to apologize for that delay, and we're glad that you're here with us now. And officially, we have 2 separate links that we've got hundreds of viewers on, so thank you for tuning in, and apologies for any confusion.
Megan, you're fired. Just kidding. So if you are just tuning in, I guess we had a little bit of a technical gaffe there.
We did it on the last one, too.
Yeah, very. I thought it was a very important intro. So make sure you go back and watch that intro, because we've kind of really laid the groundwork for to really talk to what I feel is the power behind the information we're going to share with you tonight. So if you missed that intro and you're just joining us now because of that technical gaffe, I implore you, please take a few minutes when this is over, go back and watch the beginning, that first 5 minutes of tonight's outlook. It's going to be worth your time. Okay, so Eric, if you could please go ahead and bring up that first slide where we talk about real interest rates. So I'm going to allow Chris to take the lead here, and I'm going to participate to the extent of trying to really kind of break down what you're saying or what we're seeing in terms that maybe everyone who is listening understands.
Troy's being nice. Troy will translate what I say. So my background's institutional. I tend to talk institutionally a little too much, so it's good that other people can translate. The chart you see here, if you pull it up, we've shown this, I guess, for a couple months now. So people on TV talk about interest rates. They talk about treasury interest rates, the 10-year bond, what your mortgage is generally set off of. You can break a treasury yield into 2 components. There's the inflation component, and there's the real interest rate component. And you add them together, and that's the nominal interest rate. Right now, 10-year yield, it's about 3, okay? And there's 2 components. This chart shows the real component. This is known as the TIPS yield. It's the real yield. It's the real interest rate. It's used in calculating most of the times equity risk premium, which some institutional people talk about. It really is the component that drives valuations in the market. And you can look at the chart and you'll see for all of 2021, it was under 0. You know, the Federal Reserve was keeping interest rates really low, and they were trying to force as much money as they could into the economy, force people to borrow, printing money. And come November, and I think it's circled there, they came out in one of their releases and said, hey, it's time for us to raise rates.
So November's the first circle, correct?
Yes. Yeah.
I know that I know the charts are a little bit, maybe a little bit difficult to see on the x-axis and probably the y-axis there, but we're looking at the overall trend, and this is going to hold true for most of these charts. So you should be able to see a circle there. That first circle. This is November of what year?
21.
November of 2021. That first circle there is what exactly, Chris?
So it's just when the Fed had their November meeting and said, we're looking at raising rates probably sooner than you thought and higher than we thought. And the market immediately started to adjust, both the bond market and the stock market. And these charts, the level doesn't matter as much as the trend. And what you'll see is the trend in that chart all of a sudden starts to go up and to the right, which for this chart is bad, and for the stock market is bad.
Yeah, so this chart, again, it's showing what we call real interest rates, which is indicative of growth, correct? Yes. The expectation of growth. And as this chart goes up, the stock market typically goes down. Okay, so this is not a stock market chart. This is the real interest rate, which is taking into account interest rates minus inflation. And typically when this chart is going up, the stock market is going down. So you have a second circle there. So that second circle, it's a spike when real rates rise or hit a certain level. What is that second circle?
That is late in the first quarter, and all of a sudden real rates fell. And if you go back and you look at a chart of the S&P 500, miraculously during that time period, the S&P 500 had a very, very strong rally. It rallied, I think, from 4,200 back to 4,600 or something like that, almost in 2 weeks.
Which is not what you would expect.
No. And then, of course, the market peaked, and all of the rest of the second quarter up until June 16th, the stock market went down pretty much in a straight line, and this interest rate went up until that spike you see where there's a circle, which was June 16th. And that is so far is the absolute low in the stock market year to date.
So that ultimate spike that you see in that chart right there, that is about June 16th, and that is the peak in real yields, and then you see them turn over. And as they turn over, coincidentally, June 16th was right around the lows in the S&P 500, and that's when we had a lot of capitulation. We had a lot of phone calls from people saying, Troy, are you sure that we should be invested now? Are you sure that we should keep our money invested? And what we're showing you tonight, none of these pieces in and of themselves are a direct action item. They're not necessarily complete by themselves, but when you combine them with a lot of other information, most of which maybe not most, but a lot of which we're going to share with you tonight. But then you combine that with experience and understanding of what's going on from an economic standpoint, from a monetary standpoint. They're all pieces of information. So I don't want anyone to take that they should just track real yields and then try to trade it or make investing or retirement decisions. That's not what we're saying. But it is a signal. It is.
We should have a don't try this at home.
Yeah, don't try this at home. Very, very important. But it is a signal. And again, it's almost like the markets are always constantly trying to tell us a story. Deciphering that story is ultimately our responsibility, and it's how we may tilt portfolios in a certain direction, cyclicals or staples or energies or financials, value versus growth, et cetera. So it's, again, not an exact science, but we see in that chart, June 16th, the peak in real yields, coincidentally, which, again, it could be something that we would expect to see, is when the stock market bottomed. And that trend on the bottom side, Eric, could you put it up one more time, please? You see it break through the bottom trend there. So breaking through that bottom trend, again, this isn't a guarantee of what's going to happen in the stock market, but it's about the direction. It's about the trend of these things. Just one piece of information, but it's breaking through that bottom side there.
Correct. And so going forward, if you were to look at this, if you were to chart this online, you would not, and we don't want to see this real yield really going above 0.5%, which is about where that top spike was. If you want to know what happened this week, the stock market went down, real yields went up the last couple of days. And so it's very highly correlated, very highly correlated.
Okay, so that's the first kind of piece of information we want to cover tonight. The next one, we want to move to market volatility. And volatility it's one of those terms that you hear quite frequently on television, and I don't think most people truly understand what volatility is outside of it means the stock market is moving. Volatility can be a good thing. Volatility to the upside. Volatility could be a bad thing. Volatility to the downside. But it's a quantifiable number, something that we can calculate based on the statistical data of not just past performance in the market, but future estimated or projected, I wouldn't call it betting, but the futures market, essentially. We're talking about, can I say bets? Is bets an okay word? Insurance. So investments that people are making on future expected volatility to protect a portfolio. So insurance. So what we're seeing here is future volatility, a chart. And Chris, to explain a little bit more about the trend and how this applies to market forecasting.
So if you turn on CNBC, if you turn on Fox News, Bloomberg, 99% of the people who talk about volatility talk about the VIX index. We don't talk about the VIX index. It is a math equation. It's almost meaningless. It's of no predictive value. However, there are future contracts on volatility that are traded. You can go out and you can buy a contract for future volatility for Christmas or next tax season. They're tradable, and it does have some predictability to it, to how it translates back to the stock market. It's actually one of the key indicators I use in coming up with these forecasts out in the future, just by triangulating some numbers with regards to volatility. So for the first time since last November, if you look at this chart, the first time since then, volatility had been increasing every month since last November. It's up and to the right.
And not just that, but each time it's making new highs. And the lows
were higher as well.
Higher lows. So
Yep.
higher highs and higher lows.
Which, if that's a stock, you want to own that stock. But as volatility, which means your stocks are probably doing the exact opposite.
So what this is, it's actually on the x-axis at the bottom there, that's in real time according to the date. But what you're seeing in the candles on the chart, those are actually the price of insurance or volatility in the future.
Right.
Okay, so that's what we're tracking is the future estimate that traders, ultimately it's institutions, are pricing future risk. I know that's complex, but the most important thing to take away here is we see a very clear uptrend. And what is the time frame, Chris, of that uptrend?
So, not coincidentally, the absolute peak in this volatility index, which is 4 months out, was June 14th. Two
Okay.
days, I think it was the Tuesday before the stock market bottomed.
So another one. So you see it right there. It crosses through the trend. It breaks the trend to the downside. That's June 14th when it
No,
breaks
the
through?
absolute peak is June 14th.
Okay, the June 4th, the peak there is June 14th.
The last high it makes
Okay.
is June 14th.
And then it looks like probably, what, a week or two later, we break through the downside there and break the trend?
It's a couple weeks. Yep.
So again, another piece of information. It's not absolute, but we're starting to put pieces of information on top of one another. So Eric, if we...
Oh, so and why this is interesting is so we were in a uptrend in volatility since last November, and it lasted through June. So that's 8 months. When these trends in volatility change direction, as they seem to have been, they don't just change and all of a sudden usually go back to the same trend. They are establishing a new trend. So this isn't to say that volatility is going to the good old days of 10 to 12, which is where it was in 2017.
And you're talking about spot volatility there, the VIX that that a lot of people talk about.
In 2017, I think the stock market, the biggest drawdown was 1.5% the entire year. And everyone loved it because stocks went up almost every week in a straight line, but it never gave you the opportunity to buy the stock market. When volatility is high, it actually is an opportunity for those people who are longer term. When volatility is high, you can buy some things and you have a longer time frame than that hedge fund who's getting the margin call to sell everything at the lows.
Yeah. And I recently did a video, I think we released it. Eric, did we release the one about I think we released it this past Thursday, how to manage your money in the accumulation phase. This is a great example of why when you're younger, if you're in your 20s, 30s, 40s, if you're still a ways away from retirement, that when markets are the most volatile, and this goes true too if you have a longer time horizon if you're in retirement, that's really when we should be accelerating purchases into the market. That's where the concept of dollar cost averaging comes into play. So
one other thing I want to say on volatility is there are advisors out there who will tell you, I'll get you out and I'll get you back in. And it's impossible. I've yet to find an advisor who can do it in a manner that moves the needle consistently. And even look at this year, the market is already back to the levels it was at the end of January. The overall market, single stocks are down a lot more, some are up, but the overall market is around where it was in late January. So you essentially would have had to, sell at the very end of the year, buy at the in middle of June, and otherwise you're just churning things up. So if you're going to make big asset allocation decisions to take money out of the market, you make those decisions, which are a lot of times emotionally driven. They shouldn't be. Make it when your emotions are low, which is when volatility is low.
Or make it when your greed is high.
Correct.
Right, and your fear is
low.
Yeah.
Your fear is low.
So, and I mean, you said it in a polite way, Chris. I mean, truth of the matter is, if anyone really could get your money in and out of the market and protect it consistently over time, they'd be worth multiple trillions of dollars and not be managing money publicly because you could make a fortune at killing. So that has been proven false, obviously, over the time, academically, empirically, pretty much no matter which way you look at it. So, okay, next slide here, Eric. We're going to talk about, and I was shocked when I saw this slide. Okay, this is, and part of it is because of the what the Federal Reserve has done, I assume. But this is Eric, the next slide up there. Yeah, thank you. Okay, so this is a chart essentially showing investor sentiment, but it's really a chart of idle cash institutionally sitting on the sidelines. And I was shocked when I saw this.
Yeah, so This is a chart, Merrill Lynch, I think, publishes it. They do a survey every month, and they just aggregate everyone's cash as a percentage of the money they manage. So when I was at AIM, running a large mutual fund called Constellation, we would carry 1%, 0.5% cash, because our benchmark was the S&P 500. And if the market was going up, if the S&P was going up, and we had 5% cash, it was almost impossible to beat the S&P 500. And our marketing department would get on the phone and call us and say, you know, you're ruining our business, get the cash invested. So what this shows from Merrill Lynch is cash levels in June and July,
Keep it up,
institutionally, went to over 6.1%, which to an individual, it doesn't sound like a lot of money, right? But when you're talking about trillions of dollars invested in active management, 6.1%, and then the S&P starts to rally like it did from 3,650 all the way up to 4,300 in 8 weeks, 6.5% is enough for you to lose your job. And marketing departments hate it, sales departments hate it, and it forces people to kind of get into that FOMO, the fear of missing out stage. And so that cash on the sidelines is there such that now, throughout the rest of the year, probably on any decent percentage decline, and by decent, I'm probably only 3 to 5%, this money is going to want to come back into the market for the rest of the year.
And it has to come back into the market at some point, because they're going to have to, if they want to keep their jobs, chase returns. And I'm talking from, I assume this based on what their responsibilities are. Their job is to, especially the S&P funds, is to keep up with the S&P if they're somewhat similar. But they're going to have to get that money invested to try to catch up to what the S&P 500 is actually doing. Is that correct?
That's usually what happens in the fourth quarter. And specifically in November, December, when you start to hear the Santa Claus rally and stuff, a lot of times it's FOMO from institutional managers, just trying to get invested in the market, tactfully buying more stocks, buying more positions in stocks they already own, trying to help their performance for the rest of the year. I won't use the M word, but it's been known to happen. Manipulating, prices of equities at the end of the year at large mutual funds. It's just the natural marketing department saying you're behind your benchmark, you have to catch up.
Otherwise, I can't do my job from
or
the
we're going to
marketing
lose money.
perspective.
Yeah, we're going to lose money.
And so what I was really shocked about this chart, just real quick, and we'll move on to the next one here, is more cash on the sidelines institutionally than in April of 2020 in the middle of COVID. So we saw, now we don't believe there will be the same type of rally. I should go ahead and say that we had in the second half of 2020 that we talked about. The institutional cash, though, did contribute, along with the easy monetary policy and the what the Federal Reserve was doing. It did help contribute to that big rally in the second half of 2020. But if we look here, this shows institutionally there is more cash on the sidelines right now, as of July 2022, than any time since October of 2001. Now think about that for a second. Where is that money going to go? This isn't your money, okay, unless you're working with a large institution. This is institutional money, so they have to get that money invested at some point. It's, again, no guarantee, but we're starting to stack signals on top of one another. And what does that mean for you, essentially, is that you should expect there to be more money flowing into the market, and that kind of contributes to the overall premise. Yep. Okay, so the next one, market breadth. So many people may not know what market breadth is. And the market indexes or the market indices, a simple way to explain it is a lot of times the top 10 or 20 stocks, they could be up, let's call it 2 or 3% on the day. But the bottom, let's call it 450 stocks, 480 stocks, could all be down. But the index may still actually be up for the day. So it's complicated, and I'm not going to go into the math calculation there or why that is. Just understand that a lot of times the bigger companies in the index, a small number, they could be up. Hundreds of other companies could be down, and the index could post a positive number for the day. That would be low breadth, okay? Large breadth would be most of the companies within that index are higher.
Yeah, I can simplify this one in that if you put all five, actually there's, believe it or not, I think there are 505 stocks in the S&P 500, which doesn't make sense, but if you put all 505 stocks on your screen, it's the number of stocks that are green versus the number of stocks that are red, and that's it. Apple, even though it's 7.3% of the S&P 500, is no different than the smallest stock in the S&P 500 that's 0.1%. So if Apple's green, it counts as 1. If that small stock is green or red, it counts as 1. And they just net them. And you want broad breadth. And part of the problem late in the year in 2021, and some of our concerns about the first half of 2022, was the breadth in the market was narrowing. Small cap stocks, if you look back, peaked all the way back in the first quarter of 2021, and they were essentially declining most of the year. Then mid-cap stocks kind of peaked midsummer, and finally by the fourth quarter, the only stocks that were really going up were some, I think, energy stocks, and then some large cap tech stocks. It was very narrow breadth, and of course, the market rolled over in the first quarter. The opposite has happened the last 6 weeks since the bottom in June, but more specifically, it was around, I think, July 13th, 18th, someplace, and then market breadth has exploded to the point that it's rarely happened, I think 11 times in the last 80 years or something like that. And it's portended very good things over the next year.
So Eric, if you could bring that up just one more time, that slide there. So what we're seeing here is this is the S&P 500 after 2 out of 3 days with more than 85% of the New York Stock Exchange up within 30 days of their 52-week low. It's a mouthful there, but what you should know is that this has only happened, what did you say, 11 or 12 times?
11 times.
11 times. The average one-year return is 23% from that point.
13, sorry.
13 times. The average one-year return is 23% with 100% probability of success. Now, 100% probability does not mean that it can't fail next year, okay? But again, it's another piece of information. We're starting to stack data, and when this has happened 13 times in the past, 100% probability of success with an average return over the next 12 months of 23%.
Yep. And this is one of the indicators that we were looking at. There's other breadth indicators that I think we put on some of our podcasts prior to this one that we were talking about when we did our podcast, Opportunity Knocks Early on July 1st, July 4th weekend. We did it because the first half was so bad, and I think this is another one of our podcast titles is I'm so bearish, I'm bullish. The first half was so bad that if you look statistically, historically, there are very few instances where the second half doesn't have a very, very large rally, to the point that almost, I have the data, but on most occasions, you rally all the way back to flat on the year by the fourth quarter. You might not get back to flat because I'm sure there are a lot of people at the end of the year who are like, okay, uncle, I'm getting out. But you can return almost all the way back to flat by the end of the year.
Okay, we're going to move on to the next one. And if you attended our most recent event that we live streamed, it was actually our I shouldn't say our first live stream because we did the one last year, but this was an impromptu live stream that we did 2 or 3 weeks ago. Yeah. And James, our senior portfolio manager, talked a little bit about the surprise of corporate earnings that we were seeing because the strength of the U.S. dollar. So when the dollar is stronger, typically that can hurt profits because when sales are made overseas in other currencies, those currencies have to be converted back to U.S. dollars. And when that conversion takes place, when the dollar's strong, you're getting less dollars for that currency for that sale you made over in another country. But earnings, despite the strong dollar, were surprisingly strong most recently. So this chart here, Eric, if you can bring this one up, shows us the trend here of the U.S. dollar. And Chris, talk a little bit about this one and the expectation moving forward.
Yeah, so this chart, it's the dollar. You're interested in the trend, right? And the trend all year has been straight up, pretty much like it was in last time period, I think it was 2013. It's moved pretty much as far and as fast as the same amount in 2013. It's been a detriment to revenue of the S&P 500. It's been a detriment to earnings. The first half, we expect this trend to peak. It looks like it's peaking already. Not to get much worse to the upside. Any kind of slowing of the dollar increase, or if it were to roll over and go down, it would help earnings. It would help investor sentiment here domestically and through the rest of the world, really.
And not to go too far down this rabbit hole here, but it talks a little bit about what the market is expecting the Federal Reserve to do to a certain extent, right? Because as interest rates rise, the U.S. dollar typically gets stronger. So with this kind of turning over, is that not saying that, hey, you know, the Federal Reserve is still going to raise interest rates, but it's saying 5%, 6%, 7%, those types of high rates down the road over the next 12 months, not really a big concern here.
No. And I know a lot of our clients and a lot of retirees, they read a lot of newsletters, and they go to a lot of websites that talk about the demise of the dollar. They're selling you sensational news, right? This shows you what's going on with the dollar in real time. Is there a concern one day down the road the dollar is debased against something else? Possibly, but I can't figure out what it would be. I don't want to own the Chinese renminbi. I don't want to own the Russian ruble. Bitcoin isn't replacement. I don't know what I would want to own besides the dollar, maybe some gold, you know, maybe hard assets like real estate and stuff. But when it comes to transacting in currencies, to date, it's still the dollar. And when you start hearing personalities on TV like model Giselle, who I think in 2008 said she never wanted to be paid in dollars again. She only wanted to be paid in euros and the Brazilian real. You should turn off the TV and do exactly opposite, because you know, the dollar is still the base currency of the world. It may not be in 20 years, but if someone can come to me and give me a logical place for that money to go, you know, I'm willing to listen.
So what this means for you is that we've had a very, very strong dollar, and that's primarily because the world has expected correctly that interest rates would begin to rise, so people can get more for their dollars deposited in the United States, which creates a demand for U.S. dollars. And here we see dollars increasing, or the value of the dollar increasing on a relative basis. So as that turns over and the dollar becomes weaker, it is actually likely that we would see a positive impact to corporate earnings, which supports higher stock market valuations, more growth. This also talks a little bit about interest rates. When we have a little bit lower interest rates, the mechanism that's used to discount future cash flows and the price of a stock, it can increase the valuation of equity prices. So a lot to be read from this chart, but what it means for you is it's another kind of piece of information supporting some of the other pieces of information that we've seen.
Yep, for the second half. I mean, the strong dollar has been a boon for, you know, people traveling from America to Europe, you know, or to Japan this summer. Everyone keeps talking about how cheap things are. This is why.
Okay, so I'm going to spend a little bit of time on this next slide here. The long-term S&P 500 over the past 35 years. So I know when it comes to the technical trading side, a lot of people are familiar with the 20-day moving average or the 50-day moving average. This is something that I've not seen, Chris, until you introduced it to me. But this is, tell us what this is.
This is the same thing, just zoomed out. So instead of looking at 20-day and 50-day, we're looking at 20-month and 50-month. So this is long term, right? These moving averages aren't going to move very fast. They are long term. They have a very good reliability with regards to, are we in a secular bull market or a secular bear market? Because they're slow. And as you can see from this chart, I tried to circle the time periods, the last 35 years, that the chart setup has been similar to this. The two times I didn't circle are the dot-com bubble and the great financial crisis.
And those are the two where you see break through the trend there. So you have 1, 2, 3 circles initially. That is when the stock market, the S&P 500, tested the 200-month moving average. And each time it bounced off that in affirming or confirming a secular bull market. And the 2 times that it failed to test support and broke through, or excuse me, it failed to hit support or bounce off support and crash through, was the dot-com bubble and the 2007 to 2009 recession. So ultimately, unless we think that there is something structural in place that is catastrophic, such as the near collapse of the banking industry, the real estate industry, the mortgage world, or the dot-com bubble where we had, stocks hyperbolic as far as the price performance, the dot-com craziness that transpired then. Unless we see something like that, which is the only time over the past 35 years we've dropped through that support level at the 200-month moving average, then we're bouncing off of it now.
Yeah. On TV, everyone's looking for analogies. Some people say it's 1974, others say it's 1994. Other people want to go back to the 30s when no one was alive and managing money anymore. This is just a chart telling you that with all those analogies out there, you've got 2 choices the last 35 years that there's a bad outcome. It would be a third. And so you have to think that the current environment is the beginning of the great financial crisis round 2, or the beginning of the dot-com bubble round 2, or you'd have to go all the way back to the very beginning of the 70s, pre-1974, because even in the 70s, there were periods that the market was down and it rallied back to near an all-time high in the second half of the year. So, yeah.
So just one piece of information here, like I've been saying.
And just to put it in perspective too, not to get too granular, but on this chart and over the next 2 to 6 weeks, it is a very important time in the market. It's an important time just because I know people are going to bring up the Fed and earnings, but all the technicians will be looking at this chart over the next 2 weeks and 6 weeks, because where the market closes at the end of August, where it closes at the end of September, is kind of a big deal. It'll give us a lot more information.
Okay, moving on to the next slide here. This is a very kind of cool slide. I did not know this until going through the numbers here. So these are the recessions post-World War II, and this comes from Ben Carlson, who has an excellent blog with a lot of good information there. So it's pretty self-explanatory. I hope you guys can see it fairly well on your computer screens. But what we see here is that overall recessions, whether they're technically defined as 2 consecutive months or quarters of contracting GDP, or we're looking for the National Bureau of Economic Research to formally pronounce that we are in a recession based on whatever data that they're looking for. Long story short here, and that is what Ben Carlson is using for this research, we see 6 months prior to the recession, the market performance, during the recession, but most importantly, the 1-year, 3-year, 5-year, 10-year returns of the market post-recession. So whether we are in a recession or not in a recession, we're going to have Ryan Kenny on here later, talk a little bit about some of the conversations that he's had with clients. We may bring this up, where many people say, Troy, I want to get out of the market. I feel like a recession's coming. What this chart is showing us is that a recession may or may not come. That's not our job to predict a recession. Our job is to position portfolios to be diversified against such risks that could cause your portfolio to perform at a level that is worse than your emotional willingness can sustain, or at least can withstand to sustain your investment plan and your retirement plan. But one thing I do know is not when the recession will come, is that a recession will come. So our job from the investment side is to keep diversified portfolios and communicate to people, yes, a recession will come, but this is very clear in regards to the performance of the market pre, during, and post-recession.
Yep. Yeah, we've shared some other data such that by the time GDP growth has bottomed, right, the market is already up 21%. So by the time the government comes out and says, we just printed minus 3.5%, or actually even just look back. So June, I think we were down 1.5% or something, negative 1.5%. The market, if that was the low in GDP growth, the market, by the time we know that that was the low, the market will already be up 21%. And by the time we find out that next quarter is growing, so maybe it's up 1%, the market will be up another 11% before they even print that quarter. So if we're not doing the NBER definition, it's 2 negative quarters of GDP growth. We had them. First quarter, second quarter, they were both negative in my book. S&P 500 bottom June 16th.
And we've had the best July.
We've had the best July already in decades. And, we'll probably have positive GDP growth in the third quarter, which they won't announce until October. The market would be up another 11%. You would already be back approaching new all-time highs by the time they say, okay, the economy's growing again.
And this is why when we build portfolios in retirement, it's about risk management, but it's about the financial plan as well. Investments are one component, but we don't want to make rash decisions. We don't want to allow the emotions to guide us, but statistically, we can quantify the risk in any given portfolio at any given time. If you think about guardrails, your portfolio right now, however you're invested, has certain guardrails with a certain degree, statistically speaking, of probability to not go beyond those guardrails. Your guardrails may be plus 50% and minus 50%. They may be plus 25% and minus 15%. Either one of those scenarios, your portfolio has some type of guardrail. So when we talk risk management and building portfolios to help you have the income that you need to sustain your quality of life, not run out of income, to make sure that you're okay, your spouse is okay if something happens to you, combined with a tax plan, all the stuff we do on the retirement planning side. The investment planning piece is that risk management component is critical to helping to develop the rest of that plan. Because if our guardrails, emotionally speaking, we don't want the portfolio to lose more than 20%, well, then we should build a portfolio that statistically isn't going to lose more than 20% in about 95% of scenarios. So it's the foundation of the rest of the retirement plan. But what we can't do, and what this chart shows us, is deviate from that investment strategy whenever we think a recession is coming. You should have the portfolio diversified well enough prior to any recession coming, or prior to any bull market for that matter, to withstand what the market throws our way within your emotional capability, but also with respect to the plan. But then understand that even during the recession, in most of these scenarios, it looks like at least half, the market is positive. And then in all but 1 year later, the market is up double digits.
Yeah. Yep.
Okay, Eric, want to move on to this last cycle here, or excuse me, the last slide where we talk about the presidential cycle. And Chris, first, just briefly, what is the presidential cycle?
So market historians break down every president from when they're inaugurated through when they leave. And they just look at the stock market returns and break them down quarterly, and then they aggregate them. You can break them down, all presidents, or Democratic presidents, Republican presidents. They can move things around, look at who's controlling the House of Representatives, Congress, all different combinations. Doesn't matter who's president. What are the best returns, whether they're Democrat or Republican? What time period?
Yeah, and that's a good point. So whether it's a Democrat, whether it's a Republican, the stock market, for the most part, does not care. The stock market cares about corporate profitability and future expected cash flows, and they discount them to what we call a present value. So yes, higher taxes, yes, more regulation. These things can slow down in an economy. There's no doubt about that. But this is why when we said, many people told us, Troy, Chris, if President Biden or President-elect or candidate Joe Biden wins the presidential election, we think the market's going to crash. We think everything's going to go to heck. We tried to tell people the best we could that it didn't matter if President Trump won re-election or if Joe Biden won the presidency. We felt very confident that the market was going to accelerate into the year end, and we missed it by about 0.5%, the Q1 2021 returns of the S&P hitting 4,000. That was a massive move to the upside, and we felt confident in that forecast no matter who won the presidency. So this is quite simply what this is showing you. If you could pull that back up, that in year 2 of a presidential cycle, so that's what we're in now. Interesting enough, Q2 and Q3 historically are negative, and that's what we've been going through. So that is completely 100% normal. Q4, we see about a 6.1% increase to the stock market. And then year 3, which is next year of this presidential cycle, historically speaking, on average, we're looking at about a 16% annual rate of return. And this data is going back to 1990.
And there's data farther back, and it might be a little less, but the trends are the same.
Trends are the same.
The best time period for the stock market historically has been fourth quarter of the second year, so midterm year, through the third year. And the rationale is that's usually the incumbent president and their party loses a lot of seats in Congress, so the other party, whether they're Democrat or Republican, neuters the president and their agenda, so nothing gets done. And what the stock market likes is consistency. So if there are not all sorts of new spending programs and tax programs or whatever programs out there, they can kind of figure it out. They know what the pieces on the puzzle are.
And last polls I saw, I think the Republicans were projected to at least take the House of Representatives. So. And when that happens, what happens is the market is okay with gridlock, because the market knows that for a couple of years that there's some element of certainty coming into a policy standpoint, meaning there's not a lot of policy that's going to get through. And that creates a certain element of a known quantity of what's going to happen, which historically speaking isn't a bad thing for the stock market. So, Chris, these are all pieces of information. I'm sure if I would have challenged you to come up with pieces of information that opposed our point of view, I'm sure you could have done that as well. But these are very strong, very predictive pieces of information. It's not the whole story, because we don't have hours and hours, or at least we don't think many of you would stay on for hours and hours to see us go through it. What is ultimately your forecast for the second half of 2022?
So we should approach all-time highs. I don't think we probably get there. I think there are probably enough people who have losses that towards the end of the year, they probably want to take some losses and gains. So, we can get back to 4,700 to 4,800, right back to where we were back in November, December of last year. Then, the big question is what happens what happens in 2023, and right now, those same indicators that had those numbers out there 18 months in advance, in 2019 and 2020, those are saying that 5,100 to 5,250 on the S&P 500 in the second quarter is probably the peak for the first half, someplace in there. I can get some really crazy year-end numbers for 2023, but it would have to be the Fed decides we're not raising rates anymore, inflation comes down a lot.
Some type of catalyst.
Yeah. Russia goes away, backs out of Ukraine, China calms down with Taiwan. But I can get some crazy numbers for the end of 2023, but they wouldn't last. They wouldn't last.
And most importantly, we had a lot of questions pre-submitted. How does China's position against Taiwan impact the stock market? How does we'll run through some of these later. I think the most important thing to understand is that when you have an investment portfolio that's structured around your needs, your time frame, you have a plan for taxes, you know where your income is coming from, you're not dependent on capital gains to supplement your retirement income or to provide your retirement income. Capital markets have proven decade after decade after decade that they go up in value, that they increase in value. Now, there are no guarantees, of course, but historical trends are pretty clear here. If we can keep a focus on what's mattered, try to tune out the noise as much as possible, invest in good companies that we expect to increase profits and cash flows year over year over year, stay diversified, not be too concentrated in any one position or any one sector, then we can really start to position ourselves to expect decent returns over time. These moment to moment, week to week, month to month elements or activities in the market, whether it's domestically or on the global stage, we shouldn't be worried too much about. And I think that's really just...
Well, I worry about them all the time. It's just you can't control them, right? So
Exactly.
People ask me what's my biggest worry, and it's China invades Taiwan in late 2023, or early 2024, in front of the presidential election. If I were China, that's when I'd do it, and that would be really bad.
And
it would be really bad.
Well, that's a segue into the financial planning conversation that we're going to hop into right now, because if that is a big concern of someone's and you're in retirement or whatever concerns you may have, it's very important to not have more money at risk than you can afford to see drop, whatever your risk number is, whether that's 20% or 30%. Having too much money at risk is one of the biggest mistakes that people do make in retirement, and that causes sometimes irreparable damage to the portfolio because the values have decreased to a point where it's very, very hard to come back from. So we are going to bring up Jessica Cannella to talk about financial planning. Jessica is the co-founder and president of Oak Harvest Financial Group. And Chris, if I could borrow your copy of your questions over here.
I have one all ready for you.
Okay, so
I think it's an amazing segue into the conversation that you and Chris have been having, which, by the way, guys, awesome job. I felt that it was very clear, very concise, and really provided a lot of perspective for what to anticipate and what's already transpired. It's also a wonderful segue into one of the questions that I really felt pulled and compelled to answer, and it was this question right here, Troy, if you'd like to read it.
Okay, so we had a whole bunch of questions pre-submitted. Obviously, we cannot get to all of them. We're going to try to cover as many as we can here. Jessica's going to cover a few. We're going to bring Ryan up to cover a few. So someone wrote in, we would like to hear more about strategy and how to navigate the market when someone is only a few years away from retirement.
So this is a very common question that I often hear in meetings, and I think it's a great question. And the second piece to that is I always come back to that word strategy. So much so that I've looked up the definition, and the definition of strategy happens to be a plan of action to achieve a goal for a desired outcome. And if we liken that to somebody's investment portfolio, I'm sure that this individual, not sure, but I can be presumptive from my experience that maybe they were hoping I would answer that question by saying as you approach retirement, you should take some chips off the table or pull back your risk. But without having context for who this person is and what they need to happen in their retirement, where their income is going to come from, a few years, even that is subjective to what does that mean to them. Is it 3 years? Is it 5 years? Is it 1 year? And maybe two? So we need to really step back and consider, before we want to talk about strategy, what is the outcome that we're trying to reach? And I think that this question is unanswerable, provided those facts, because it's not an answer that you should be seeking, it's a discussion, and preferably with professionals that can ask the appropriate questions that will help you to assess what is most important to you in retirement. And professionals are going to think about things like taxes, like all of your various streams of income. And, I think it's such a huge transition from going from you're accumulating wealth when you're working and you're making your contributions to your retirement plans to now you're a few years away from making a decision where you're going to have to distribute that wealth back to yourself. And that the sun rises and it sets with income planning. When we talk about paying ourselves back in retirement, and income planning needs can look so different from individual to individual. This question is just so interesting to me, and I love it. So thank you so much for submitting it. I handpicked it to discuss because I just think it's very important that we really hinge on that word strategy. Asking a question like this without having any background or context would be very much like asking me to plan a road trip for you, and you pull up to a gas station, roll your window down, we don't know each other from Adam, and you're like, hey, I'm going on a road trip, and I'd love to see some awesome sights and end up in a beautiful destination. You got 3 minutes to explain to me, and can you please give me directions for my route? You can see that is not strategic. In order to have strategy, you need to have a plan of action, and there are a lot of questions that need to be answered.
Well, and I would bring up that it's fluid to a certain extent. One thing that comes to mind for me is, we'll talk a lot of times about Social Security planning. So it's a big part of the overall income plan. And we'd like to see multiple streams of income in retirement. But, let's say they had a certain strategy that they were implementing, and maybe they were 75% towards stocks, maybe 25% towards lower income or lower risk type tools, and maybe the market does significantly crash, or even if they're 60-40, a more traditional allocation. When we start to look at the fluidity of the decisions that we make in retirement, if things are unexpected as far as the performance of our accounts to the downside, we might have a serious conversation about turning Social Security on sooner than we were otherwise planning because the market was down.
It's dynamic, right? And so is life. It's going to keep changing. It's going to unfold. And we're talking about retirement. We're not talking about, I would like to say it like this. Retirement, you don't retire and then, that's it. I mean, it could be if you pass away, but then really planning is going to be beneficial to you and your family. But it's not the end. It's a new beginning. And how long is that new beginning? Time horizon is so important here. Is it 20 years? Is it 30 years? Is it 40? I mean, you can bet your bottom dollar and probably get some money back that life is going to be dynamic over a 40-year period or even 20 years. And so your plan needs to be a path to start down and have some built-in flexibility. And I think that that's really where, we're providing value to our clients in that they have a team of professionals that spans far beyond just financial advisors, CPAs, estate planners, people who are going to have conversations with you about your medical needs, your planning around, the healthcare costs is inflated at 8%. And so there's just so many variables. And to your point, life is going to change, and having a dream team of professionals to turn to and spitball ideas, that's the kind of context that you need on an ongoing basis to make really informed decisions.
And we need multiple tools too. So I had a conversation with a client who said, Troy, I'm glad when we were looking at investment grade corporate bonds and government bonds over the past 2 years, and both of those tools were on average down about 15% over the past 2 years. So it's not just about stocks and bonds, it's also about having multiple tools. And if income's important to us, we want to have tools that can provide income. If making sure that we don't have market losses is important to us, we want tools that aren't going to lose when the market goes down. So it is a complex discussion.
Yeah, and it really starts with a lot of discovery. What is the income gap that you're trying to solve for? Some people are lucky enough to have pensions, and they have a piece of the income puzzle solved, and that's not most people. And some people are lucky to have maxed out their Social Security, and they're going to get $4,000 a month. That's not everybody. And so really putting into context who are you sitting down with and what is important to them, then you can start to talk about the how. And the how will change over the time period that you are investing for. I think what this, again, I think that a big question is allocation models. I hear that all the time, and it's what worked while you were working. When you sat down with an advisor and they talked to you only about risk willingness, what's your risk tolerance, are you conservative, more risky, and then they have this, maybe it's a target fund and it's slowly backing off of equities and going more into the bonds. And you mentioned that bonds are not really a, sound place. You didn't say that explicitly, but I've had a lot of questions in meetings like, what is happening to bonds? And that's, where do I put safe money? And it's just impossible to answer without having done the due diligence that is a fiduciary to understand that person's unique situation.
So this other one circled here is, where can I invest my nest egg where it can protect the principal and grow at the same time?
I mean, everything that I just said, it is the same answer to that question, is that I could rattle off a quick answer right now and tell you that the insurance industry might be a good place to investigate. Some fixed annuities or CDs, things that are...
I saw fixed annuities recently, I think 4% over 2 or 3 years. Ed, did you see that? 4% for 2 years? 3% for 2 years, and I think I saw a 4% for 4.1 for 3.
But again, it brings it back to the conversation. Yes, that's and kind of comical that we're excited about that. But that's relative to what growth means or what the growth needs are for the individual. You might need more than 3%. Or, hey, if you have $5 million, all you need is 3%. And so the show must go on, or when we lost one of our lights. But I hope that, at the risk of not sounding like I'm being direct, I think that you really set yourself up for failure to succeed if you're not doing your due diligence to really outlay your whole financial picture. And annuities, CDs, safe spots, bonds, real estate could be another option that's a little bit more stable and cyclical than just your stocks, ETFs, mutual funds. But without really understanding the individual, it's really difficult to say, yeah, stick it here.
Yeah. But, kind of big takeaways from there is ultimately the stock market, and what we've talked about during this entire time is really, it's a tool for growth. But it does come with risk, of course, as many of us are fully aware of. There are many more things to a retirement plan than just stocks and just the maximum growth tools.
Yeah, it's a part. That allocation model, it's a part of a plan. It's not, and the plan is the sum of its parts. And so to have diversification and look to different tools to incorporate, that's where you can then begin to put some strategy behind your allocation model and your investments. Let's say that a fixed index annuity is a great tool for you, or a fixed annuity, and you have $1 million portfolio. You decide to protect, I'm making up numbers here, 300,000. All right. Well, now maybe with the other 700,000, you can be a little bit more adventurous in your investments portfolio, if that makes sense for your income needs. The biggest question, I believe, is when could you potentially need to access those assets, and in what economic environment? And those questions can be answered through working with professionals.
Yeah. You need a plan, ultimately, like we talk about all the time.
That's a quick way to say it.
Okay, Jessica, I want to thank you very much for coming up and sharing your insight into what you've been seeing, talking to clients, and also answering some of the questions. I want to go ahead and bring up Ryan Kenny to talk a little bit about what he's seen on appointments as well. And we're going to be closing out here, and I'd say about 5 or 10 minutes, but I want a couple of interesting things here. This is Ryan's first time actually on YouTube. So Ryan, how do you feel?
Oh, great. Say hi, Mom.
Okay, so
we have one viewer.
One.
Tonight we talked a lot about the investment planning, what we see from a forecasting standpoint. Jessica did a really good job tying it into the financial planning side of things. When it comes to some of the client feedback that you've heard about Chris's podcasts, those clients that do listen to it, some clients that don't listen to it maybe, what's some of the feedback that you've received from people who do listen to the podcasts?
I think most are just extremely thankful for the connection they feel to, one, their retirement nest egg, right? It's so important to feel that connection. You've entrusted a firm to manage that retirement, right? All the goals, everything you've worked your whole life for, and you have all these questions every day, every month. Chris is putting this out. They've entrusted us. And the same works. We have clients that hire us that don't listen to it, but they trust us and know through that process of hiring us that this is what we do. So you have both sides, but yeah, it's just it's a great tool for us advisors to one, regurgitate in meetings, but at the same time, it
helps people stay current with what we're doing on the investment side. So we recommend typically semi-annual meetings when it comes to reviews, and we spend a lot of that time reviewing your financial plan, your tax plan, your income plan. We'll talk about the investments, of course, but what I find a lot of times, and let me know if you find it as well, those that are listening to the podcast that you're putting out every single Friday, the News or Noise, which again is a separate something that you're putting out on a weekly basis. Those people, we spend a lot more time talking about their tax plan, their income strategy, and really not a ton of time talking about the markets or the portfolio, because they feel so connected to the even when things are bad in the economy. I find people don't ask a lot of questions because of what Chris is doing, putting that content out there. And I do find that to be the same.
Yeah. I mean, I think the News or Noise segment, and correct me if I'm wrong, I think it was kind of born out of the feedback we get from clients of, hey, I heard this, and the timing might be when we have one of those reviews, or it's an email or a phone call, but it's just another connection to something they're hearing to their retirement, right, and their plan that they have. So I think it's great, and just separate from news and noise. What should we be paying attention to, and what should we tune out?
So a big thing, Ryan, I wanted to talk to you about, because you're in the mix. You're doing 4 or 5 meetings a day with clients, reviews, new clients, and taxes is a huge part of what you do with clients, really helping people to create plans to pay less tax in retirement. So talk to me a little bit about one aspect of that Roth conversion planning and how that ties into what we've been talking about in the market or the investment side of things tonight.
Yeah. So Roth conversions are, this forward thought process that we're going to pay a little more tax now to make ourselves more efficient later. We definitely want to find efficiency now and efficiency later. There's a fine line, and it's going to be different for everyone. Everyone has a unique situation. Roth conversions aren't necessarily for everyone, but it's definitely something we want to look at. And ultimately, do we want to take control of those taxes now ourselves, or do we want to be controlled with required minimum distributions? It's really looking at it, getting in, building that plan, looking at that analysis to say, here's the path we're on. Is this going to be important? And most of the time it is, because we're looking at the age group that's been retired now, right, or approaching retirement. That conventional wisdom has said tax defer, tax defer, tax defer, right? So now we have a bulk of our retirement savings in these tax deferred accounts, and
they're invested.
They're invested,
taxes.
absolutely.
Yeah.
So when are we going to pay those taxes? That's the question. It comes to not just making yourself more efficient, but also legacy, right? Legacy is an important part of that too.
And the thing that I oftentimes get across when I'm sitting with people, it's not, it's not if you're going to take money out of that retirement account, it's when.
Right.
Because whether you do Roth conversions or not, you're still going to take that money out of that retirement account. What Roth conversion planning does is it allows you to have control over when you decide to take that money out,
right,
how much tax you pay. And if you're in the boat where you think taxes are likely going to be higher in the future than they are today,
yep,
well, we have more control doing those conversions now, because we aren't forced or mandated to take a certain amount out,
right,
and also possibly paying a higher tax rate in the future. Then when you look at all the other income sources that you have, you may be forced down the road to pay a much higher rate than you're anticipating. Right. And we see that a lot. And a lot of, you and I were talking just recently about how many people you've been helping over the past couple of months with the market being down. So one of the things we do is we encourage Roth conversions when the market is down. So a lot of firms simply wait until the end of the year. Now, a while ago, we said that really doesn't make any sense, because when the market's down, we can convert a larger percentage of the shares in your account because the market value is down, as opposed to waiting for the market to come back up. It's a lower percentage of that account that you actually get to convert. So you and I were talking recently about all the conversions you've been helping people to take advantage of over the past few months. And that makes a big deal for people. That can be tens of thousands, maybe hundreds of thousands of dollars down the road in additional savings.
Oh, absolutely. And getting good timing through the year of when we can do this, whether that's a 2% pullback or maybe what we've seen this year. It's important. It moves the needle. But I think priority one still remains that we have the plan for it, and in the years we're planning for it, we execute. I think that's so important that over the long run, it's only going to help us to become more efficient later in life, whether that's for ourselves and or for legacy. But if we can find the right time during the year, like right now, what we're experiencing, the market's going to be higher in the future. So any time's a good time at some point, right?
Yeah. We believe the market's going to be higher in the future.
Well, yeah,
History
no guarantees.
tells us it's going to be higher in the future.
Absolutely.
Ryan, I want to thank you very much for
Thanks.
coming on. Great job.
Absolutely.
We're going to have to bring you back.
All right. Thanks.
And for those of you who maybe thought that was Jared, if Jared is your advisor, Ryan is actually Jared's twin. So that was definitely Ryan. That was not Jared. So that closes us out tonight for the 2022 second half outlook. If you have not subscribed to the channel, please go ahead and subscribe to the channel. That allows us to keep you more connected to your money, and you stay more connected to us and the content we're putting out. Up to 5 videos a week. I do 2. Chris does 2, and then Jessica's putting 1 out a week as well. So thank you very much for tuning in to the 2022 second half